Hello traders, you're welcome once again to our YouTube channel. I hope your week was great. Hope you are doing great. Hope you made some profits over the past week of trading. Today I want to share with you a very important powerful strategy that you can use to maximize your profits from the forex market. As you're aware, I bring you strategies and information as to how you can become more profitable and successful in your forex trading career. If you're yet to subscribe to this YouTube channel, please kindly subscribe to our channel, turn on the notification bell so that you can be alerted when I post a video. And if you're a returning subscriber, I want to thank you so much for your support. Also, you might want to join our free Telegram channel. The link to that channel is in the description box of this video. So let's get straight into the topic of today. Today I want to talk to you about how to trade complex pullbacks, using the Fibonacci retracement principle. How to trade complex pullbacks using the Fibonacci retracement principle. Or strategy. Okay, so how to trade complex pullbacks using Fibonacci retracement principle. So this strategy is very, very important and is very powerful. It is very, very powerful. Now, this strategy is hinged on the principle of price movement. Price does not move in a straight line. The market does not move like this. The market does not move in a straight line. The market does not move in a straight line, either to the right side or to upward or downward. All right, the market can either move upward, downward, or in a sideways. All right, but the market do not move in a straight line. Does not move in a straight line like this. That is not how the market moves. The market moves like this. Moves in a zigzag manner. All right, the market pushes up, retraces, pushes up, retraces, pushes up, retraces, pushes up, retraces, pushes up, and retrace, and continue like that. And the market push down, retrace, pull down, replace, retrace, pull down, retrace, pushes down, retrace, pushes down, and so forth and so on. So the market does like breathe in, breathe out, breathe in, breathe out. All right, breathe in, breathe in, breathe out, breathe in, breathe out, breathe in, breathe out, breathe in. That is how the market moves. All right, the market does a breathe in, breathe out, breathe in, breathe out, breathe in, breathe out, like that. Even if the market is to move in a sideways, it doesn't go in a straight line. It goes this way. All right, so if you understand this principle, this is the principle on which the market is hinged. And this principle and this strategy I want to be showing you has to be used. It must be used either in a bullish trend or in a bearish trend. It should not be used in a sideways market. That is, when the market is consolidating. This is a sideways market where the market is consolidating, but this is a bullish phase, this is a bearish phase. So the market, this strategy works in a bullish phase or in a bearish phase, never not to be used in a sideways market. In fact, most strategies work well when the market is trending. All right, when the market is trending upward or trending downward, that is where most strategies you find in the forex market work. Most sideways trading do not actually result in a loss. All right, in a loss, except if you are trading support and resistance. But most strategies that work, that has a higher win rate, works in a trending market. All right, so now this, how do you capitalize on this? How do you capitalize on this? Now let us see. The market pushes up, retraces, pushes up. Now this is A, B, C, D. The market always does an A, B, C, D movement. This is like in a bullish phase. This is another one in a bearish phase. You have like this: A, B, C, and D. This is what the market does. This is what the market generally does. All right. So you need to understand this principle. So if you have a market that is trending, push up, retraces, push up. Now, when this market pushes up, you are trying to get into this trade. All right. So the best time to get into this trade is when the market does like a retracement. When the market does a retracement, you have A, B, C. All right. Now you have another A, B, C. So this C is where you're looking at to get in, so that you can buy up. All right. You can buy up. So you need something that will inform you where this C would be. That is the principle I will be showing you right now. All right. Using this Fibonacci retracement. Now you also have in a bearish form, the market is trending down. All right. So you want to get a retracement back like this. This is your A, B. Your C is your entry. C is usually your entry. Okay, you are waiting for market to make a C, that is to retrace backwards, so that you can have your entry right this point and sell down. So the principle that will actually help us is the Fibonacci retracement tool. All right, how does it work? Let us go into the chart so I can show you how it actually works. Like you can see, in this case, this is a bullish phase. Okay, let me get us a better example. All right, you can see that this market is making this something like this. All right, so we want to see where we can enter here. We want to see where we can actually enter. Now, let's assume that the market has stopped like this, and the market has made this movement. All right, the market has made this movement. So we want to see where exactly we can enter. We need to get a retracement here where we can enter to this. This will be our A, this will be our B, this will be our C. So how do we know that this point is the right C, the right entry point for us? So that is why we want to use what is called the Fibonacci tool. Now, how do you get the Fibonacci tool? How do you get it? So to get it, you go to your chart. You go to your chart right here. This, if you are using, you go to your chart right here. You can see this. You come here. This is the Fibonacci retracement tool right here. This one. This is the Fibonacci retracement tool. All right. So you click on it. Click on this. Click on it. So when I've clicked on it right now, so to get my retracement, I will draw from down to up. All right. How do I know? You need to draw. If you are in a bullish phase, you draw your retracement from the swing low to the swing high. Why? You need to, because you are moving up. In a bearish phase, you are drawing your retracement from the swing high to the swing low. From the swing high to the swing low. All right? From the swing high to the swing low. So in this case now, you can see that this is our swing low here, and this is our swing high right here. Let me make it clear. Let's push the retracement tool away, so you can understand what I mean. All right. So this is our swing low. This is our swing high. So we want to see where this would retrace to before we can get. This is our A, this is our B, this is our C. We want to see where this will retrace to and form like a support, so that we can enter into the trade and buy up. So that is why we need a Fibonacci retracement tool. So I want us to use this tool right now to know exactly where we are supposed to enter this trade. All right. So let us drag it. Let us drag the tool. Let's drag the tool. So I put it from here. So this is the swing low. This is the swing high. All right. So as you can see, in this case, let's extend the tool. Let's extend the tool. in this case, the market actually did not take one of the levels. Though before now I would have shown you there are about 5 levels. There are about 5 levels that we expect the Fibonacci any of the retracement to happen. There are about 5 levels. You can see this level. This is the 23.6, 38.2, 50, which is like the half. All right, that is 61.8. That is 76.4. Now, hardly do the market come to this 100. All right, hardly. These are the 5 major levels that the Fibonacci actually, five major levels that determines where the market is supposed to reverse. All right, if the market, in a case whereby the market obey this principle, you have the 23.6. Okay, let's write it here. You have the 23.6 level. You have the 38.2 level. You have the 50 level. You have the 61.8 level. Okay, you have the 76.4 level. The market most times retraces from any of this level. All right, so as this retracement is happening, it's supposed to take support from either 26, 20, 38, 50, 61, or 76. All right, but in this case now it passed through and took support from the 100 level. Hardly do we take support from the 100 level. All right, so let's assume that the market took support right here. So what you need to do right now is to do what? Is to draw a flag. Draw something like a flag. That will show you where. So when this flag is broken on a Fibonacci level, after making support at the Fibonacci level, that should indicate your entry. In your entry, and you are taking profit from at the size of the first move. Your take profit should be the size of the first leg of the flag. I don't know if this is clear, but let's look for another example. Let's look for another example that best depict what we are actually looking at. So let us look for another example. Let's look for another example. Okay, now we've got another example. We've got another example here. Let's see. Okay, this is a sell scenario. Here, the market is moving in a bearish phase. All right, so here you can see. Okay, so we want to see where this is our swing high, this is our swing low. We want to see where this point, this is our A, B, C. So this is supposed to be our entry, but how do we know that this level is going to hold before the market sell down? How do we know what to do? We need to apply our Fibonacci tool. So just like in the first time, we do what? We go to our Fibonacci tool and we draw in a bearish phase. You draw from swing high to swing low. All right, from swing high to swing low. Can you see? Now this is our swing high, this is our swing low. So we want to see where this market is going to retrace. So you can see it retraced from the 61.8. So what I'm supposed to do, when I see that the market is retracing, I will not know how to know the point, because the market can choose to retrace at 23.6 or 38.2 or 50 or 61.8 or 76.4. So how would you know that the market is going to retrace or the market is going to blast through and reverse? Okay, because in this case the market can choose to reverse or can choose to retrace and continue to sell. So how am I going to do? No, how I'm going to know is this. When I've drawn this Fibonacci tool, this is my swing high. I draw from swing high to swing low because I'm in a sell, I'm in a bearish trend. So the market started retracing, and when it gets to 68.1, what I need to do, once the market starts retracing, I should draw my flag. I should enclose retracement in a flag. This is the first leg of the flag. I should now draw my retracement. I should enclose the retracement in a flag. All right, I should enclose the retracement in a flag. This is a flag. This is what I mean by a flag. This is the flag pattern. I made a separate video on flag patterns. All right. So I should, when I have, this is the first leg, A, B, and C. So I'm looking to get into the trade anywhere from here. And this retracement started happening, and so I need to enclose the retracement in a flag. All right. So, and you have your Fibonacci levels. All right. You have 23.6, you have 38.2, you have 50, you have 61.8, you have 76.4. In fact, just know that the most important level where the market, most times the market always retraces from 61.8. This 61.8% is the golden level. Most times the market retraces from the Fibonacci level of 61.8. But what I'm trying to show you is that you should not enter blindly when the market gets to 61.8 or when the market retraces to 56, to 50 or 38. Sometimes the market can retrace from 38 level, 38.2, or from 23.6, or from even 76.4. But most times the market does retrace. From experience, the market does retrace from the level of 61.8. But that does not mean you should get into the trade, because the market can continue to sell. Sorry, the market can retrace, and instead of retracing back, it will just reverse. So because the market can either retrace and continue in the direction, or it can have a total reversal. All right. So I could be waiting for the market to retrace and sell. The market could just reverse and continue to blast through all my Fibonacci levels and continue to buy instead of selling. So that is why I need to enclose my retracement in a flag. So when I do that, I'm getting into the trade when the market have taken one of the Fibonacci levels as a support, as a resistance, because we're in a sell phase, as a resistance. And when this flag is broken to the downside, I should get into the trade. I'll place my stop loss just above the flag. Stop loss. This will be my entry just after the flag has been broken. Now, what will determine my take profit? As usual, your take profit for while trading a flag pattern is the same distance. Your take profit is the same distance as the first leg of the movement. I don't know if this is clear. This should determine my take profit. Some persons will take profit at the extension, at the Fibonacci extension. All right, but for me, I don't feel that is safer. All right, what is safer is that you should take your profit, just trade it as a flag pattern. All right, but ensure that the retracement happened. The retracement, the market reversed from one of the retracement level. Either in this case, it was from 61.8. So this gives me double confirmation. The market has retraced from 61.8, but I will not still get into the trade until I see that my flag, enclosed retracement in a flag, has been broken, and I'll get into the trade, and I'll take profit just as the size of the first leg of the flag, of the bearish flag. All right. So let us look for more examples. Let's look for more examples. Let's see if we can see more examples. All right. I'm trying to see if we can get an example that where the market retraces at another level. All right, at another fib level. Okay. Now see this one. Now this is our swing high. This is our swing low. This is our swing low, and this is a bullish phase. So my retracement level should be drawn from the swing low to the swing high. All right. So let's apply our Fibonacci. So I want to see where this market will retrace to before I can get into the trade. I want to see where the market would retrace to before I will do what? I will get into the trade. So this is my A, this is my B, this is my C, and this is my D. So how do we know? Let us plot the Fibonacci tool. So as usual, we plot the Fibonacci. We are in a bullish phase, so we draw from left, from the swing low to swing high. All right. So swing low, swing high. So where can it retrace to? This is 23.6, 38.2, 50. So the market here retraced at 50, as you can see. So how do I know? I will enclose my retracements in a bullish, in a bullish flag. All right. Since this is like a bullish scenario, I will enclose my retracement in a bullish flag. So what will be my entry? When this bullish flag is broken to the upside, I'll put my stop loss at the next Fibonacci level, which is 61.8. I'll put my stop loss right here because the market retraced at the 50 level. So my stop loss will be the next Fibonacci level beyond, slightly beyond my flag. All right, this is a flag pattern. All right, so now my entry will be at 23.6. all right, this is my entry, 23.6, where at the other side of the flag. So my stop loss will be right here. So I'm getting into the trade. What will be my take profit? My take profit will be the size of the first leg. My take profit. I don't know why this is clear. This strategy is a very important strategy. It's very powerful. It's a powerful strategy. All right, so just note things you need to note. Note that if you are drawing the Fibonacci for a bullish scenario, in a bullish trend, you draw the Fibonacci from swing low to swing high. All right, because you are buying, you are moving up, you are drawing from low to high, you are buying. In a bearish scenario, bearish trend, you are drawing your Fibonacci from the swing high to swing low, because you are moving downward. All right, so can we see one more example? Let's see one more example. We have done, this is a bullish phase. Let us see if we can get another bearish phase. Let's see if we can get a bearish scenario before we now wrap this up. All right, yes, this is a beautiful one. Look, so let us see. This is a swing high, this is a swing low. All right, so this is a swing high, this is a swing low. So this is a swing high for us, swing high, this is a swing low. So let us see where the retracement will happen. Let us see where the retracement, we want to have a retracement and want to sell down. Where would this retracement happen? Where? Swing high, swing low. Now let us apply our Fibonacci tool. Let's apply our Fibonacci tool. All right, so we draw from high to low, swing high to low, because we are high to low, from up to down, since we are selling. So we draw from here down. Okay, we extend it. Okay, so this is our swing high, this is our swing low. Now we enclose our retracement in a flag. This is the first leg, flag, retracement. You can see it retraced and took support at the 38.2, at the FIB 38.2 level. That is not to say I'm not going to enter the trade until my flag is broken. So my flag was broken right here, and I'll get into the trade entry I'll enter at 23.8 level, 23.6 level. This is my entry. So this was where it retraced. This is my retracement of support, where it took support. My stop loss will be at 50. All right, retracement at 8.2. Entry when flag broken, 23.6. Stop loss will be at the other side of the flag and at the other FIB level of 50. Now my take profit should be approximately the size of, this is my take profit, the size of the first leg should be somewhere around here. All right, so this will be my take profit. So I hope this is clear. This is a wonderful strategy. You are combining the flag pattern plus the Fibonacci, okay, to increase your win rate. So this strategy is powerful. So let us do a quick summary of what we just, of our entry criteria. Let us do a quick summary of this strategy. You need to, how do you trade the Fibonacci, the complex pullback using the Fibonacci tool? About eight steps you need to take. The steps. Let us conclude by saying, the first thing you need to do, you need to identify the trend. Okay, when we say trend, is it on a bullish or bearish? Number 2, identify a developing retracement. Okay, identify a developing retracement. So because you cannot know where is your swing high and low until you see something that appears to be a retracement. All right, identify a retracement, either a bearish retracement or a bullish retracement. Then when you have seen a supposed retracement, what do I mean by identify your? Because when you see the market does this, the market could continue to move. So you don't know, you can never know until you see a developing retracement. All right, like in this case as well, you don't know if the market will continue to this way until you see a developing retracement that will inform you that it might be time to get in. We are waiting for a pullback. We're waiting for a pullback. All right, so let us see number 3. So you have to, number 2 says you need to wait for a developing retracement. So the third thing you need to do is mark swing high and swing low. Okay, mark your swing high and swing low when you have seen a developing retracement. Number 4, for a bullish, okay, number 4 is to do what? To draw your Fibonacci. All right, or apply your Fibonacci. And you know how to draw. I've shown you how to draw. For a bullish scenario, if in a bullish trend, you are drawing your Fibonacci from down to up, since you are buying from swing low to swing high. For a bearish trend, you are drawing your Fibonacci from your swing high to swing low, since you are selling. You are moving from up to down. All right, that shows you what to do. Draw your Fibonacci. Some people draw it in different ways, but from my experience, I'm telling you the right thing to do. Draw your Fibonacci in line in the trend you are going, your intended direction of buy or sell, your intended direction of trade. So number 5 is to do what? Enclose the retracement. Enclose the retracement in a flag. All right, apply the flag pattern. Enclose your retracement in a flag. So number 6, you need to enter the trade on a breakout. Enter on a breakout of flag. Enter on a breakout of the flag pattern. All right, when the price has used one of the retracement level as either a support or a resistance. Okay, number 7, you place your stop loss. Place stop loss at the other side of the flag. All right, the other side, opposite side of flag, or Fibonacci level at the other side, opposite Fibonacci level. The next Fibonacci level, if you're in a buy scenario, down, in the Fibonacci down, downwards your entry. If you're in a sell scenario, the Fibonacci above your entry. All right, now the final point is you're taking profit. Take profit at the same size of the first leg of your flag. All right, so you take profit at the first leg of your flag. This is a powerful strategy. All right, so these 8 steps will guide you. Number 1, identify the trend, whether bullish or bearish. Number 2, identify a developing retracement. All right, identify a developing retracement. Now number 3 is to mark your swing high or low. Mark swing high and low. And I've told you how to mark your swing high and how to mark your swing low. Now the 4th thing is to draw your Fibonacci or apply your Fibonacci to your chart. If in a bullish scenario, from the swing low to swing high. A bearish scenario, from the swing high to swing low. Number 5, enclose the retracement in a flag. Enclose the retracement in a flag. Number 6, enter on a breakout of the flag when price has used any of the Fibonacci level as a support, as a resistance, as the case might be. All right. Number 7, place your stop loss at the other side of the flag. If in a bearish scenario, at the upside of the flag, and the next Fibonacci level beyond, above your entry. If in a bullish scenario, the next Fibonacci level below your entry, and you're taking profit at just at the size of the first leg of the flag. I hope this is clear. I hope this is clear. So please just backtest this strategy and see how it works. It works very well. All right, backtest this strategy and you'll see that your win rate will improve. I've done a previous video on how to trade the flag patterns. All right, and I'll link it in the description box of this video. But adding your Fibonacci to the flag pattern will skyrocket your win rate. So if you're yet to join my free Telegram channel, please, you will see the link to that group in the description box of this video. And if you want me to mentor you personally, I have countless number of strategies that can help you. And if you want me to mentor you and take you by the hand until you become a profitable forex trader, I'll teach you and mentor you until you become a profitable forex trader, one-on-one. I don't run collective mentorship. I run one-on-one mentorship. The reason is because I always say it is because I believe that each individual has a unique learning curve. So I stoop down to your level of knowledge and help you and understand until I give you assignments and I review your assignments until you get these concepts I teach correctly. All right, until you become good at it. All right. So if you want me to mentor you, my contact is in my free Telegram channel, and you can see the Telegram channel at the description box of this video. So till I come your way next time, do have a wonderful and a blissful day and a prosperous week. Bye.